This is shaping up to be the most dramatic housing crash we have ever seen. Mortgage rates haven't been this high in over 23 years. Meanwhile, in October, sales dropped to the lowest level since the Great Recession. Now the number of home listings is rapidly rising, and sellers are having to slash their prices to be able to strike a deal. The market already hit a turning point. New data suggests it's all downhill from here. Real estate agents, home builders, and mortgage lenders are getting increasingly pessimistic about the future of the market. Americans are extremely worried about losing equity in their homes or losing their homes altogether. Several stats reveal that another disaster is imminent. So it might be helpful to homeowners and prospective homebuyers to identify the warning signs so that they can be prepared. For that reason, today we share the latest and most shocking facts about the housing downturn that is already unfolding. Without further ado, here are 15 warning signs that a terrifying housing crash is about to burst. 1. The era of unsustainable price increases is now behind us. From the pandemic to the end of the last year, home prices rose at the fastest pace in U.S. history, jumping from $329,000 in January 2020 to a whopping $479,500 in December 2020. That is an impressive 45% increase. Without a similar increase in wages happening during this period, it became clear that the U.S. housing market entered a massive bubble. However, this year, conditions started to deteriorate as the Federal Reserve raised interest rates to levels last seen during the turn of the century. That figure fell to $441,000 at the end of the first quarter of 2023, and again to $429,000 at the end of the second quarter. In quarter three, the average home was sold for $406,100, which shows that the trend that kept prices at unsustainable levels for several months is no longer in place, while a new trend of price cuts is now rapidly spreading across the United States. 2. Mortgage rates are insanely high and won't go down anytime soon. With the Fed pledging to keep high rates for longer and hinting that more rate hikes will be necessary to bring inflation down to its 2% target, mortgages will remain expensive for much longer than anticipated. At the moment, the national 30-year mortgage interest rate stands at 7.87%. That is the highest point in 23 years. This is leading average new buyers to pay roughly $3,000 per month for their mortgages, and that's according to Black Knight. In contrast, the average American earns just $4,600 per month, making that large part of a payment unaffordable for most and severely impacting demand at a time when more supply is entering the market. 3. Home sales are sharply dropping after months of rapid acceleration. When home sales rapidly fall after growing consistently year after year, it could serve as a warning sign of a housing market crash. That's because declines in sales volumes can affect home appreciation. And when enough sellers are unable to find a buyer for their home, they will have to lower the price to attract more buyers. In the third quarter, home sales plunged by 15.1%, meaning that the number of existing homes sold fell to levels not seen since the fallout of the Great Recession. With mortgage rates nearing 8%, the majority of would-be buyers are currently priced out of the market. That is leaving sellers no choice but to significantly reduce their asking prices right now, which, by the way, leads us to the next sign. 4. Sellers and home builders are cutting property prices at unusually high rates. According to data provided by Zillow and Redfin, a record number of sellers dropped the prices on their listings in the past quarter. In September, the percentage of home listings that had a price cut jumped to 9.2%. And in October, that figure went up by an additional 7%, an unusually high month-over-month increase, analysts said. Moreover, the National Association of Homebuilders reported that 32% of homebuilders slashed prices in the past month, with an average drop of 6% nationwide. 5. Meanwhile, housing inventory continues to grow. The supply of unsold homes in the market is starting to pile up. There are now more than 500,000 homes unsold active on the market. The latest numbers shared by the National Association of Realtors show that the U.S. housing inventory is almost 6% higher than it was a year ago. A market that's saturated with homes sitting on the market for long periods signals waning buyer interest, explained Andy Kolagi, owner of Property Leads. Even though we're not quite there yet, we are already seeing supply levels rising in many markets, while demand for homes is plateauing. If the number of properties on the market is increasing, but the demand is keeping pace, that is a significant indicator that there are more sellers than buyers, and the market is about to face a major shift. 6. Shadow inventory is likely to change the game. On top of visible listings on the market, there are houses known as shadow inventory, or properties that are not officially listed but could potentially enter the market at any moment. According to Redfin, there are approximately 5.5 million properties that fall under that category. If a significant number of shadow homes suddenly become available for purchase, the market could be over-flooded by supply, which would push prices down. Distressed properties, foreclosures, or homes held by sellers waiting for better market conditions contribute to this shadow inventory, explains Rakita Asrani, owner of Century 21, St. Martin Real Estate. A sudden influx of these properties can intensify market competition and exert downward pressure on prices in the months ahead, she added. 7. Buyers are not feeling confident right now. For a homeowner or a buyer, the idea that a housing market crash is on the horizon can be really disturbing. The last thing you want is to be responsible for an enormous, overvalued asset while the economy is falling apart. One of the weird things about the economy is that it's a self-fulfilling prophecy. If people think that the housing market is not going well, then there's a good chance it could tank in the near future. When people believe conditions are unfavorable, it's a sign that they don't intend to invest in a home at the moment. You can check on how consumers are feeling about housing by looking at Fannie Mae's monthly Consumer Sentiment Survey, which asks consumers if they think it's a good time to buy or to sell a house and why. Last month, the survey revealed that 85% of consumers indicated that it's a bad time to buy a home, with most respondents citing inflation and high mortgage rates as the primary reasons. That was the worst consumer confidence reading in 11 months, and a confirmation that demand for homes was cooling all over the country. 8. Real estate agents and home builders are also pessimistic. Real estate agents can see issues on the ground as they emerge. That's why their insight is extremely valuable, especially during critical periods. According to NAR's Realtors Confidence Index, in October, the number of agents who expect an increase in buyer traffic over the next 3 months dropped to 8%, compared to 11% in the prior month. Sentiment also deteriorated from August through October from 72 to 64 points. In addition, last month, builder confidence fell to the lowest level since January. The monthly National Association of Home Builders Wells Fargo Housing Market Index dropped 4 points to 40 in October, and September's read was revised down 1 point. Anything below 50 is considered negative. That marked the third straight monthly decline in builder confidence. Builders have reported lower levels of buyer traffic, as some buyers, particularly younger ones, have been priced out of the market because of higher interest rates. explained Alicia Huey, NAHB's chairman and a homebuilder and developer from Birmingham, Alabama. 9. Mortgage lenders are starting to freak out. Most of us need a mortgage to buy a house, so when borrowers are tightening credit conditions, that's also an omen that the market is headed for trouble. To see how lenders are feeling, responding to ongoing trends, and what they're expecting to happen in the market, you can also check Fannie Mae's quarterly Lender Sentiment Survey, which tracks lenders' forecasts about their profit margins, mortgage loan demand, and mortgage refinance demand. The most up-to-date report reveals that mortgage lenders are starting to restrict access to loans as losses continue to rise. The delinquency rate for mortgage loans on 1 to 4 unit residential properties increased to a seasonally adjusted rate of 3.62% of all loans outstanding at the end of the third quarter of 2023, according to the Mortgage Bankers Association. Now, overall, the delinquency rate was up 25 basis points from the second quarter of 2023 and up 17 basis points from 1 year ago, a worrying development for the sector. 10. Risky mortgages can trigger a domino effect. As big financial institutions become more cautious about borrowing, smaller firms with lower credit standards start offering riskier mortgages in the market. When these lenders loosen up underwriting standards too much, such higher-risk mortgages can spark a housing crash because they could be offered in bulk to buyers who can't actually afford their homes. That's what happened in 2006 and 2007, when there was a boom of subprime loans, which ended up fueling the housing crash, the financial crisis, and of course the Great Recession. Even though more mortgage regulation was introduced since then and banks had to increase lending standards, emerging firms have continued to overlook some required information and required documentation about the borrower's ability to afford the home, credit scores, and down payments. Their services tend to gain popularity when traditional borrowers begin to cut credit lines. Given that their data isn't public, there's no way to tell how big is the problem before it becomes far too big to ignore. 11. Lots of loans that are being originated require mortgage insurance. You probably know that the standard down payment on a home is 20%, but at current prices, many buyers are unable to put down that large an amount. For that reason, mortgage insurance, or private mortgage insurance for conventional loans, is now required for borrowers who are considered riskier because they do not have a 20% down payment. That can become a huge issue, given that homeowners who lack large savings purchase a home that can potentially experience a higher amount of outstanding debt than what the home itself is worth, leaving them with negative equity. This is especially risky when homes are being overvalued, which is precisely the case right now. 12. Foreclosures are shooting up all over the country. It's typically a bad sign when people can't pay their mortgages and foreclose on their homes, but when that happens at scale, it can mean a housing market crash is near. A foreclosure happens when the owner of a home defaults on their mortgage loan, which causes the bank to take back possession of the property and put it up for sale at auction. When people are unable to pay their mortgages and foreclosures rise, it signals financial struggles on a large scale, noted Alicia Huff, a real estate specialist at Sell House. To find this information, you need to closely monitor foreclosure filings and activity, both nationally and in your area. Real estate data analytics firm Adam updates these numbers monthly and quarterly, so you can compare the market's activity and understand what's going on. The firm found that U.S. foreclosure filings jumped by 22% in the first quarter from a year ago. During the second quarter, the number of homeowners hit with foreclosure notices climbed to 28%, and in quarter three, foreclosures reached a high of 34%. Researchers highlight that foreclosure activity has increased on an annual basis for 23 straight months. 13. The housing bubble can grow larger before it collapses. One important factor that suggests trouble is a reinflating pricing bubble. With sellers offering price cuts and most buyers still priced out of the market, this is the perfect market for speculators. They can often pay in cash or outbid other offers, snatching homes that would normally be sold to families and helping to keep the bubble alive. The potential for a reinflation of prices is a real issue. If price growth starts to accelerate again, that means the Fed will have to raise rates to a much higher level to bring the market back to normalcy. But that could plunge the economy into a severe recession, or worse, result in an even bigger crash in the future. 14. Cracks are starting to appear in the jobs market. The cooling jobs market poses a threat to the economy and, in turn, the housing market. Unemployment jumped by almost a full percentage point since April, currently sitting around 4%. As recently as the summer, one would have described the jobless rate as bouncing around at a low level, but today it looks like a more decisive uptrend. Historically, that rarely happens except in the run-up to a recession, and once the rate rises by that much, it usually keeps rising. 15. Macroeconomic indicators point to a painful downturn. The success of the housing market is dependent on the economy being healthy in general. When the economy isn't performing well and companies are shuttering doors and laying off thousands of workers, a large share of the population can lose their main source of income. In turn, these consumers can lose their ability to pay their mortgages, and a ripple effect can hit all corners of the economy and housing markets. On top of that, decreased consumer sentiment plays a pivotal role in housing crashes, and a CNN survey exposed that 78% of Americans say the economy is on the wrong track. They overwhelmingly cited inflation as the primary reason why, suggesting shoppers are fed up with the soaring prices of goods and services. But unfortunately, the era of higher prices is here to stay. At the moment, corporate and personal bankruptcies are exploding all over the United States. Consumers are carrying huge debt loads. This is the recipe for disaster, and a lot more could go wrong before the end of the year. Housing bubbles don't happen out of thin air, and the same is true for housing crashes. There are always early signs that indicate things are starting to get out of hand in the market, and we need to recognize the red flags before the downfall begins so we can safeguard our finances. We hope this video has been informative to you and that you prepare accordingly, because many factors are expected to impact the economy in the months ahead. The key to weathering the storm is staying informed about local and national housing trends and ensuring your financial situation is stable enough to survive the turbulence. Thank you for watching, and thank you for subscribing to Epic Economist.